Hello everyone, it's Beau Benjamin with Beau Benjamin Realty Group here, powered by eXp Brokerage. Alright, today's topic is how to sell and buy in today's market. This is extremely difficult, and this is a reason that a lot of people aren't selling their homes. They would put their home on the market, and we need that inventory desperately, but they don't know how to go about it because they're worried about buying. They hear the stories, they know it's tough to buy. They know it's tough to win offers, so they don't step out and put their home up for sale because of that fear. So today's video is going to talk a little bit about strategies in how to accomplish both successfully with a low to no amount of risk. All right. Path number one is the bridge loan. All right. What is a bridge loan? The easiest way is if you know what a HELOC is. A HELOC is an acronym standing for Home Equity Line of Credit. You can get a HELOC anytime you have a home and you have equity in your home. Typically you need to have more than 20% equity in your home to get approved for a HELOC, and a bridge loan is not much different. It's just a different term for basically the same thing. A bridge loan or a HELOC allows you to take that money and use it as a down payment on your next home. So if you sold your home, you would take that money and put it towards your next home. This is the same thing. You're just dipping into your home's equity before you sell it, and you'll have a line of credit against it, a bridge loan, and you'll take that money and you can take it and put 20% down hopefully on your next home, with avoiding PMI and getting that loan set up the way you want it. And then you go sell your home, and after you sell your home, then you apply the proceeds to pay off your primary mortgage that you've always had and this new HELOC/bridge loan. That way those are all paid off, but you acquired your new loan when you purchased your new house, and you already have your down payment applied from your HELOC, and now you're just paying that back. So it's essentially borrowing the money you need to finance your new home without having to sell your home first. All right. And a lot of the bridge loan, I will say that the HELOC typically will kick in. You'll pay that, start paying that back relatively soon. Whereas a bridge loan, a lot of times will have terms that you don't have to start payments back for up to a year. So that's a really nice feature of a bridge loan, because you don't have to make two mortgage payments, effectively your primary on your first home, and then this bridge loan payment that doesn't kick in yet. So you're still making your primary mortgage until you sell it, and then you'll be making a new mortgage on your purchase. But as long as you purchase and you start that process, I'll remind you, it's 30 days when you purchase, typically, for a loan to get financed. So the day that you get a pending loan for your new purchase, then you're going to have about 30 days. So that's going to start the clock to sell this home. So a lot of times, even though there's typically maybe a separation, because you have 30 days to do your purchase, and if you sell your home rather quickly, which it is happening in this market, that's only going to be a few days, week, maybe 2 weeks at the most, lagging behind that purchase. So you're going to pay that stuff off, your primary, your first home's mortgage and your new bridge loan, fairly quickly after you purchase your new home. So that's always the big concern. We don't want two mortgage payments. Maybe can't afford two mortgage payments. Also, this is a huge tip, by the way. Whenever you purchase a home, most people forget you don't actually pay the first payment for usually almost 2 months. It depends on what day you close. Here's a pro tip. I always recommend closing on the 6th of the month. That gives you the maximum amount of time before you have to make a mortgage payment. Anything the 5th or sooner, you skip that month. It's like, say you close on the 1st, where you're skipping the mortgage that's due on the 5th, and then you're going to pay the next month on the 5th. All right. So if you do it the 6th, then you skip the next month, and then you pay the following month. So that's the best date to close on if you're trying to do this. That gives you the most padding built in. So that's the pro tip. and then you're going to most likely sell your home quickly, pay that all off. You're probably never going to pay 2 mortgage payments if you do one of these methods that we're talking about today. All right, we're going to go on to path 2. You can do a loan with a recast option, okay? What is a recast, you ask? A recast is simply a refinance that's built in already. So a lot of times, lenders charge different amounts for refinances. A lot of times I see the refinance cost in between $3,000 and $5,000 here in Indianapolis. A recast option is typically built in at a much cheaper rate, so $300 to $500. All right, so you're going in ahead of time. You're saying, hey, Mr. Lender, I want a loan with a recast option because I'm going to apply funds from my sale of my home now to this loan that I'm getting to purchase, and that way I take it below the 80% mark, or pay off, or put a deposit to get it below that 80-20 so you lose the PMI. That's what most people's goal is in this scenario. All right, so I buy the new house, really cheap down, 3.5% down. I have that in my savings account. Boom, we bought a new house. We have 2 mortgage payments. We're going to start selling our house. As long as this loan has a recast option, usually it's within the first 6 months. Again, that varies by lender. And you sell your home, you're going to pay off your mortgage over here. You're going to have some equity probably if you're doing this scenario. And then you're going to take that leftover equity and you're going to say, I'm ready to do my recast. They're going to apply it to this loan over here that you only put 3.5% down on, and they're going to recast it, which means re-amortize. All right, they're going to do the whole re-amortization. It's built in. It's like a refinance, and then they're going to give you your 15, 20, 30-year loan amortization table, and your payment's going to drop down because of that. You're going to get rid of PMI if you had to have it temporarily. So that's another great path forward. So if you have any questions about any of these, by the way, please reach out. I have lenders at the ready to talk through in detail with you. I'm not a lender. I've just learned these tips from being in the industry, and it is important to get the specifics for your scenario from your lender. That way you're 100% comfortable with these options. All right? Path 3. This is a less used path, but it's a very viable path. It is borrow from your retirement, and I recommend this as a temporary option. But a lot of people don't realize they've got 401ks at their companies, and there is always an option to borrow against that. And the best part about this option is you're borrowing from yourself and you're paying yourself back interest. So you're not borrowing from a bank and you're not paying them interest. You're the bank to yourself. And that money's just sitting there in the market anyways. It doesn't actually affect money that you may have in a stock or mutual fund in your retirement plan. It's literally just a loan against it, and your provider, whether it be Merrill Lynch, Fidelity, all those providers, your company will tell you who yours is, usually has an option, and boom, you sign up for it, you get the loan, they send you a check in the mail, now you have your money down, you can get your new loan for your new house, and then once you sell your house again, you'll sell it, you'll get the proceeds, pay off your primary mortgage, and then you'll pay yourself back, and you'll pay yourself some interest back. It's great. All right, so that's a great option most people don't even think about because, they say, oh, I can't take out my retirement funds early before I'm 59 and a half, or I get penalized. There's no penalty for that. It's not taking out, it's just borrowing against. All right, so this is a great option. Explore that option with your retirement provider and see if that fits for your scenario. All right. Path 4. Now we're flipping things here, all right? There's multiple ways to accomplish these goals, and so far we've talked about duplicate loans at the same time, pulling out money from places, stuff like that. The other way is to sell your house first, right? We've talked about 3 different ways where you can buy a house first and then sell yours second, all right? That's it's a safe way that you're never going to be homeless, but it's a risky way in the sense you may have 2 mortgages or 2 financial obligations at the same time. This is going to totally flip the script, and a lot of people don't think about this option either. Where is the leverage at in the market today? It's with the sellers. The buyers have to give the sellers what they want to get the house, because there's multiple offers competing to buy that house. So the sellers can pretty much dictate their terms. Well, we're going to use that to our advantage. The advantage being that if we sell your house first and get the terms that we want, then we can set ourselves up for success in purchasing. And we don't have to write a contingent offer on your purchase because we've already sold your home. All right, how do we do this? This seems risky maybe. People certainly don't want to be homeless. So here's how we do it. We create the terms we want, and here's the most important thing about this video probably. People are fearful, but here's the deal. You do not sell your house until you sign. All right? So if we're going to put your house on the market first, we're not going to make ourselves homeless or any risk thereof until we sign the paper, which means that we know all the terms ahead of time. There's no surprises. We know exactly what's going to happen, and we're going to have a plan for it, and we're going to agree to it, and that way there's much less fear, much less anxiety of becoming homeless. All right? So that's so important to remember. You do not sell your house until you sign the paper, which means you know everything ahead of time. All right, so there's two different really main ways of doing this successfully. One is extended possession. Within the terms of the agreement, you retain possession of your home. And we can dictate or pick the offer that gives you the most days. Last year in 2021, we had one that we had 90 days of possession after close, which means that from the date we signed the deal, about 30 days went by before we closed. So we really had 120 days or 4 months of possession of that home after they signed that deal that day. Well, guess what? I've told all my clients this, and I'll tell you this as well. If I can't find you a home in 4 months, I probably need to sign up for a new job. I'm probably not a good realtor. So the truth is, there are homes that are coming on the market all the time, and if we're diligent and focused and put our energy every day towards finding a home, 4 months is a long time. We should find you a home and get you an offer accepted within 4 months. All right, and then the thing is, we can negotiate that possession one of two ways. We can negotiate it as free possession, which that scenario I told you, the client did have free possession for 4 months of their home after they signed that deal, or there is a rate per day on the purchase agreement. So if we can't negotiate it for free, maybe it's a $10 a day, $20, $50 rate per day. So if you think about it, like when you rent a home and it's $1,000 rent, 30 days, that's roughly $33. So you're paying rent basically at that point. It's just termed the rate per day in the purchase agreement up front. Again, remember, we know all these terms up front, and before we sign, we can do the math and figure out what it's going to cost us or whatnot. So we know all this going in. The other way is called a lease back. All right, the extended possession just means you've closed. The buying party actually owns your home because you've closed on it, but you get to retain possession. A lease back is very similar, but a little bit different because it's going to be accommodated by an actual lease agreement. The lease will be dictated by the rules within the lease agreement, which again, we will see up front if we negotiate this. And the good part about the lease back versus the possession is you can do a lease that's indefinite, right? You can negotiate a lease document that says, until we find another house, we'll pay this much per month, and then once we find the house, we'll give you 30 days notice, we'll move out, etc., and we'll move into the new house. All right, that's the best reason to do a lease back. Or you could put a time period in the lease back as well. You can say we want to lease back for 3 months. All right, but the lease back benefit to me is marking the lease as indefinite, which means the buyer's letting you lease your home back until you find a new house. Now, on the extended possession, you have to mark something. You have to say 30 days, 60 days, 90 days, etc. And then the buyer, of course, will sign and agree with that. But once that clock runs out, it runs out. Obviously, we'd be negotiating with the person if we had to try to avoid the homeless scenario, or moving into a short-term rental, more likely than homeless. But the extended possession is usually cheaper and sometimes free. So it's a little bit pro and con both ways. But that is the 4 paths to how to sell and buy in today's market. So if you have any questions, please feel free to give me a call. We'll go through your specific scenario one by one, step by step, and we'll find the best path for you. Okay? But it can be done. And if you'd like to move into a new house, whether you're upsizing, downsizing, or just moving location here in Indy, please give us a call. We can make it happen for you in a comfortable manner where you won't have a lot of stress or anxiety. Thank you so much. Please like and subscribe the video. I appreciate you so much, and I'll talk to you next time.